Welcome to the Q3 and 9 months FY25 earnings conference call of TVS Supply Chain Solutions Limited. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectation of the company as on date of this call. These statements do not guarantee the future performance of the company, and it may involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing the star, then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. J. Shivakumar of TVS Supply Chain Solutions Limited. Thank you, and over to you, sir.
Thank you, moderator. Good morning and welcome all to TVS Supply Chain earnings call for Q3 FY25 and 9 months ended, December 2024. I hope everyone had a chance to look at the financial results, which was posted in the company website and also in the stock exchange last night. We have with us today Mr. Ravi Viswanathan, our Managing Director, and Mr. Ravi Prakash, our Global CFO. We commence the call now with opening remarks from our management, along with the business performance update. It will be followed by an open forum for question and answers. Before we begin, a customary remark, I would like to point out that some of the statements made during this call may be forward-looking in nature and must be reviewed in conjunction with the risk that company faces. A disclaimer to this effect has been included in the investor presentation, and I request and hand it over to Mr. Ravi Viswanathan, Managing Director of the company, to make the opening remarks. Over to you, sir.
Thank you, JS, and good morning to all of you. Firstly, let me welcome all of you once again to our earnings call to discuss the performance in Q3 of the fiscal year 24-25 and for the first 9 months of the fiscal year 24-25. I will share with you the highlights of our performance, and as always, my colleague, our Global CFO, Mr. Ravi Prakash, will take you to the analysis of our numbers. We look forward to interacting with you as part of the Q&A session. For the benefit of those participants who might be joining the analyst call for the first time, please note that TVS Supply Chain Solutions is a secular and asset-like supply chain solution provider with two main business segments, namely ISCS, or Integrated Supply Chain Solutions, and NS, or the Network Solutions segment. We operate across 4 continents: Asia, Europe, North America, and Oceania, where we offer bespoke and tailor-made solutions in the 3PL space and also offer 4PL services in the select markets. For more details about the company, please refer to our webpage, www.tvscs.com/investorrelations. So let me get into a brief business overview, followed by the operational highlights. Financial performance in Q3 FY25 and 9 months ending December FY25. And our focus areas for the last quarter of the year. The ISCS segment continues as the main revenue contributor thanks to sticky long-term contracts. On the freight forwarding space, the Red Sea crisis continues, resulting in higher shipping costs, delayed delivery, along with other factors which affect the DFS business. The recent Gaza ceasefire has given ray of hope, but shipping lines are not likely to restore the routes until long-term security is guaranteed. That said, the mantra for companies like us and for TVS SCS is to be nimble, flexible, and be continuously innovative, which the company has been able to demonstrate over the years and which will ensure the same in the future as well. Now, moving on to the performance highlights for Q3 of the fiscal year 2024-25 and 9 months of the fiscal year 24-25. Q3 FY25 consolidated revenue grew by 10% on a year-on-year basis. And in terms of segmental performance, the Network Solutions segment continued its upward trajectory and grew by 20.4% on a year-on-year basis, whereas the Integrated Supply Chain Solutions segment grew by 2.3% on a year-on-year basis. Business development continues to be robust across the segments, and it contributed to 10.4% of the Q3 FY24 revenue in this quarter. The company reported a PBT loss of INR 15.2 crores for the quarter, and this came because of three main factors. Firstly, the company encountered a delay in commissioning a major project for a key customer in the UK, thereby delaying the revenues. Our customer is in the utility services business, and the transformational project will now go live post-winter during the summer months, that is in Q1 FY26. Secondly, multiple customers in the UK region outsourced lower than expected volumes in an unusually soft quarter, which impacted the revenue of the company. And lastly, one of the key contracts with a governmental agency in the UK got delayed due to procedural issues, and we expect the contract to start now in Q1 FY26. Amidst this, relevant costs were already built in and thereby impacting the profitability of the company. The company is taking specific initiatives in this regard for the profit turnaround, which Ravi Prakash will cover in detail later in this call. In the freight forwarding segment, the company grew its revenue impressively on a year-on-year basis. The ocean freight growth movement was driven by rising freight rates in the market, while air freight rates remained resilient in the quarter. The incremental ocean freight rates did not translate to margins due to Red Sea surcharge, which was a pass-through in nature, and hence margins were subdued. With regard to the integrated final mile, or IFM, as a subsegment under the network solutions, we are in the last lap of the turnaround to profit-led growth. Now, a quick look at the 9-month financial year 25 performance. Consolidated revenue for 9 months FY25 grew by 10.7% compared to the corresponding previous year, and PBT for the same period was INR 16.4 crores. We note that the customer volume drop in UK is seasonal in nature and will be possibly addressed in the coming quarters. With this brief background, let me hand it over to Ravi Prakash, our global CFO, who will then take you through a detailed analysis of the number.
Thank you, Ravi. Good morning, everybody. Welcome to the TVS SCS Quarter 3 earnings call. I would like to start off by talking about four key factors which are actually going well for us in the business, and then analyze the financial results in detail. In the ISCS segment, both India and North America margins are trending well, and that is expected to continue, and that is actually a solid foundation as we work through the next couple of quarters. As our managing director has already talked about, the IFM business turnaround is on track. We had messaged that by Q3 of this year, we would probably be getting to break even and start moving towards run rate profitability in Q4 and Q1 of FY26, and that trend continues. And the last point is that the IFM, the GSS business has demonstrated robust volume growth on a year-on-year basis. Yes, there was pricing benefit as well, but volume growth was benefit. So these are four positives that we as management and we would like everybody also to take note of as we go through the rest of the financials. Now let me walk you through the numbers line by line. Q3 FY25 revenue was INR 2,444.6 crores compared to 221.8 crores for the same period last year. That represents a 10% growth on year-on basis, where the network segment grew very well, almost 20%, and the ISCS segment grew 2.3%. The network segment revenue was driven by healthy volume growth in the forwarding business. The volume growth was supported by higher freight rates as well. Revenues from business development have maintained their momentum, with 231.3 crores being dropped in the quarter. And that reflects the healthy order pipeline. We have shared these numbers in our earnings presentation. Today, the pipeline stands at about INR 4,500 crores. The combination of a good momentum on the freight volume, the ISCS strong customer base, and the business development have sustained the revenue performance. Other income for the quarter was 24.6 crores, and that was primarily due to the interest from bank deposits and forex gains. With this, the total income for the quarter was 2469.2 crores, which is a 10.1% growth on a year-on-year basis. When we look at 9-month performance versus 9 months of last year, revenue grew at 10.7%, in line with what we've been indicating in the past. 9 months revenue was 7,496.9 crores versus the corresponding number of 6,773.7 last year. Segmentally, ISCS grew 5.6%, while the network segment grew 17.4%. Now, let's take a look at the major expenditure items. Material costs for the quarter were about 391.4 crores, which was lower by 9.9% on a quarter-on-quarter basis and 4.9% lower on a year-on-year basis. This cost reduction is an account of a change in the business mix in some of our overseas entities, which will carry inventory as required in some contracts. The freight clearing, forwarding and handling expenses, being variable in nature, increased due to the higher volume of trade handled in the GFS business and due to the additional surcharge levied by ocean carriers on account of the Red Sea situation. And that's why they've increased on a year-on-year basis at 27.6%. Quarter-on-quarter, they were lower by 5.4%. Employee benefit expense for the quarter was INR 590.6 crores, which is an increase of 2.4% on a quarter-on-quarter basis and 6.9% on a year-on-year basis, primarily due to the change in customer mix. And this is mainly because of deployment of people in contracts, which is absorbed in the gross margin of the customer contracts. On the EBIT front, while depreciation and amortization expenditures were lower by 3% both on quarter-on-quarter and year-on-year basis, the lower EBITDA generation in the ISCS segment has impacted the overall EBIT, which was a loss of 3 crores. Now let me walk you through the 3 key factors which impacted Q3 profitability. The first one, as Mr. Ravi Vishwanathan has already mentioned, is a delay in commissioning of a major project with a UK customer. The project was expected to go live in Q3. It has now got pushed to Q1 of FY26. And the infrastructure for the project is in place. Revenue recognition is pushed back. That has impacted the profitability. Second, and this is important to note, in general, the December quarter is a softer quarter outside of India because of volumes, because of the holiday season. We had anticipated that, but this Q3 was unusually soft for a few customers in UK. This is clearly a one-time impact because as we go through Q4 and Q1, we do not see any such trends. But that has had an impact in Q3. And in the GFS business, there has been lower margins. The three factors that I've talked about have more or less these are the 3 factors which have contributed to the drop in profitability. The focus of management is to act on a few initiatives to ensure a quick turnaround from the numbers that are coming through this quarter. First, strategic price adjustments in many contracts in the IFM business. We have talked about in the past that the IFM business, we are taking price corrections to improve margins, and that is currently on. And so we expect to see that benefit in about 20% of the revenue of the company. Second, headcount rationalization. We are streamlining the workforce. We have already taken some steps in the first 9 months, but we are going to be focusing a lot in the next coming quarters. Third, overhead reduction. We are taking steps to reduce overheads across the board. And again, we should see the benefits in the coming quarters. Fourth, infrastructure consolidation, particularly in the UK. We have already acted on consolidating a number of warehouses into larger ones, and that cost benefits also should be coming through in the coming quarters. And lastly, outsourcing to India. We have a center of excellence in Madurai. We have been moving work here, but we are pushing this harder in the coming months. We believe these measures, which are in different stages of implementation, would push us back to the normal profitability that we expect to get from this business. At this stage, I also want to make it clear, our midterm goals of a 4% PBT do not change. The three factors that I outlined are a one-time quarter impact in this quarter and not anything, structural with the business, and therefore we expect to turn them around. So I just want to kind of reaffirm our midterm guidance. Finally, there's a clear-cut plan to address the impact on overall profitability, and I would be happy to give you greater details during the question and answer session. With this, I'll hand it back to Mr. Ravi Vishwanath.
Thank you, Ravi Prakash, for the analysis. I would like to touch upon the business development and key engagements. The revenue momentum of the company is backed by strong BD. Our BD contributed about 231 crores for Q3 FY25 and 757 crores for the 9-month FY25, reflecting robust performance. And we have those details in the investor pages 14 to 16. We informed in the last earnings call how the company is able to win large deals in mature markets, both in the UK and the US, after winning transformational deals in the UK and USA. We continue our focus on Fortune 500 customers, and we will continue to add the Fortune 500 customers into our tag. During the quarter, we won a notable 4-year contract with the UK Ministry of Defence for the provision of maritime consumables and furniture to support the Navy. This enabling contract will ensure the seamless procurement of a wide range of essential items, supporting operational efficiency for the Navy. Further, in the ISCS segment, we onboarded an Indian electrical company, Indian consumer durable company, a global agri-equipment company in the USA, an international railway infrastructure company based in the UK, and a global manufacturing company based here in India. Some of the new customer wins in the network solution segments include a global wind turbine manufacturer, a UK-based consumer healthcare company, a global consulting and outsourcing company, and engineering and electrical equipment company. So, very diverse set of customers across the areas of our focus. As in the past, the pipeline of new opportunities continues to be very strong, and we are building on that strength quarter on quarter. It currently represents a revenue opportunity annualized in excess of INR 4,500 crores. Some of the key opportunities we are working in India include a warehousing solution for a large Indian retail chain, an integrated solutions to a global home appliances manufacturer, a 3PL solution including buy and sell for a global wind turbine manufacturer, and an integrated 3PL solution for an automotive parts provider. And some of the key opportunities we are working outside India include a warehousing solution for a global auto component and engineering company, an integrated 3PL solution for a UK-based automobile OEM, a technical repair solution for an industrial giant, and an integrated 3PL solution for an American auto OEM, and a field service management solution for a large retail chain. In the UK, in a Fortune 500 company, we have been now down selected and in the final stage of contracting for a large transformational 3-year 1,000 crore contract, and we expect to give you details over the next few weeks. That re-emphasizes our positioning and to the strength of our solutions and the ability for us to work with the Fortune 500 customers. To grow the scale, the company's global customer account management program is well underway. This program leverages our cross-selling opportunities, and we continue to see success and, more importantly, a very strong pipeline with our global customer account management customers. On top of the global account management, we are also laying emphasis on operational excellence, more specifically around the total customer life cycle, starting from opportunity development through launch and deployment and into post-launch continuous improvement. As such, we have created the operational excellence pillar, which is being used in all key customer implementations, and will be replicated in all our geographies and large customers. Further, as a tech-led company, we continue to offer best-in-class IT solutions loaded with security features to the customers from time to time. In summary, our year-on-year revenue growth reflects the resilience of our business. We continue to secure large deals and capitalize on significant market opportunities, leveraging our global capabilities and technology expertise. With a robust order pipeline bolstered by strong customer engagements, we remain bullish about our long-term growth outlook. With that, let me open the floor for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Disha from Ashika Institutional Equity. Please go ahead.
Good morning. Am I audible?
Yes, Disha, we are able to hear you. Thank you.
Yeah, hi. So my first question is regarding the UK contract. Can you specify the reason for the delay in contract? I'm assuming it is the 7-year strategic contract that we had signed with the government, I think last quarter. So if you could specify what is the reason for the delay in contract, and as well, you had mentioned in the presentation that the margin impact should continue in the next quarter as well as a slight margin impact in 1 to FY26. So if you could help us quantify certain, like how much cost impact should we estimate?
All right. Let me take the first part of the question, Disha. So if you look at customers' engagement, we are contract to run 2 sets of operations for them. The first set of operations went live in September. The second set of operations, which was more transformational nature, which had a lot of new technology, new business process, and a new set of teams, which was migrating from the existing distribution center to the modern distribution center. So the delays were on multiple counts. One was the facility itself got a little bit delayed. Further, technology integration took a slightly longer time. And given that we were not able to complete what we call as the business resilience testing, it is too risky to go live in winter. So that's the synopsis of the delay. Ravi, you want to add?
Yeah. Disha, in terms of the numbers, normally we do not give out contract-wise impact. But if I take the kind of the PBT change that you've seen quarter on quarter, the 3-4 factors that I've talked about probably have an equal contribution.
Okay.
Right? I talked about 3 or 4 factors. They all have an equal contribution to the delta that you've seen in our EBIT performance.
Okay.
Right? And we expect, and like we said, the contract is going to go live, expected to go live in Q1 FY26. While we have said there is an impact in Q4 and there is the contract will go live in Q1 FY26, that is specific to the contract, but we as a company are doing other things to make up for that. So that's also something that I just like to do.
Yeah, just to emphasize on that, Ravi Prakash spoke about quite a few initiatives which are all underway, which will give us significant, opportunities for us to make up for that single contract's contribution to the PBT. So I think from a program or a project perspective that's expected to go live in Q1, that particular project will have an impact in Q4, but we're confident that we'll be able to make do with all of the initiatives that we have supported by new BD. Yeah?
Okay. My second question is regarding the ISCS business. While you mentioned in your commentary that the ISCS India as well as North America business has been supporting good margins. If I see the growth rate of ISCS India business, it is just 0.5% on a year-on-year basis for the quarter, and it has declined by 3.9% for the 9-month period. So could you just specify what is the reason behind it? I remember earlier in the quarter you had specified sometime that the elections led to lower manufacturing activities, but this quarter was, if you could just quantify some reasons.
Okay. So, Disha, two things. One is, yes, we had said that Q2 manufacturing was definitely on a lower trend. It has had a slight pickup in Q3. But I think it's important for us to look at India from both a short term and a long term. We continue to win significantly large deals, which is giving us a good set of, I would say, visibility towards what it is in the future. But specifically on Q3, I would say the performance, given the fact that there were a couple of projects which exited, it is still something which we are very comfortable with from a momentum perspective. Maybe Rameshwar can share more details.
So, Disha, I think in the last couple of quarters we've been talking about the fact that in India there have been a couple of contracts that we have chosen to move out of, and we have always said that the revenue growth in India will normalize. So it is a matter of 1 or 2 quarters before you start seeing the revenue growth again. But maybe I want to spend a bit of time on the comment I made on margins. The India business has managed margins well. They have adapted, they have quickly worked on both at a gross margin as well as at an EBIT level to kind of, and cash flow management, to kind of improve their margins. And that's why we specifically called out that despite the revenue shortfall, the margin performance has been good. And the same has been the case in North America. And the reason we kind of called this out is we've always been messaging that the supply chain segment is something that we can depend upon. All 3 businesses have performed well with a margin. That the target doesn't change.
So 26 should be somewhere margins in between both the years. So there should be a marked improvement in 26 as well.
I think that's a fair assumption. In the 26, definitely better than what we have in 25, and on our way to getting to the target.
Okay, fair enough. And secondly, on the ISCS segment, we had mentioned that in last call that 11% margins can't be replicable on a quarter-on-quarter basis. So there has been some softness in 3Q. But in 4Q, can we see somewhere closer to double digit?
So, Vaibhav, on ISCS, right, you're right. I just want to kind of again call out, last quarter was an extraordinary quarter with 11.1%. In general, in ISCS, we are targeting a range of 9.5 to 10.5% EBITDA margin, right? So, we should, I think we have one more quarter where we have to work through the situation in the UK. And afterwards, we should again be getting back to, in general, for the last, if you take out this quarter, we have been operating upwards of 9% for the last 5 or 6 quarters. And that should start in, as we get into FY26, we should get back to the trajectory. We have one more quarter to work through.
So Q4 also should be similar? Some improvement we can expect.
Look, I think this time it was 8.8. Q4 should be slightly better. I probably can't put an exact number on that. But like I said, Q4 is also not the normal quarter of a 10% as well.
Okay. And like you mentioned that you have a target of 7% for NS segment in maybe next couple of years. So for the ISCS segment, that could be 9.5 to 10.5, or we can even go beyond that, maybe FY27 or 28?
Look, in ISCS, you know that in one quarter we were able to do 11. And we were immediately careful to kind of caution that, look, that was an extraordinary quarter where everything worked. The mix worked. We had some very high margin contracts coming in revenue. Everything worked. It was a great quarter. So that 11% demonstrates the possibility of what we can do. I think at this stage, we would like to stay with the 9.5 to 10.5% guidance. And then, once we get through the next couple of quarters, we can always revisit where we can go to. Our aim is always to keep pushing the margin. But at this stage, probably it's good to stay in that range.
Okay. And sir, lastly, on the revenue side, we have seen a very strong growth in the NS segment at around 17% in the 9 months. So it is quite encouraging. On the ISCS segment, we have seen the softness. So it has been in the range of, say, 4 to 5%. So Q4 also should be similar. And how do you see 26 and 27 panning out for ISCS in terms of revenue growth?
So look, ISCS, right? I just want to focus on ISCS for a minute. In general, and this time we have given you the seasonal quarters as well. December outside of India is normally a slightly softer quarter. If you look at all the last 3 years, quarter-on-quarter revenue we've given, the Q3 revenue is slightly below Q2 revenues. That's what we put out in you look at page 7 of the earnings deck. That's what historical information shows. And then we get back, right? But before that, ISCS was delivering double-digit growth for many quarters. So if I take 26 and 27, that would be our objective. And we do have a pipeline. Yes, I mean, this quarter, a few projects got moved to the right, and therefore this quarter revenue didn't come in as expected. But there is nothing that has changed fundamentally in terms of either our pipeline or structurally in terms of our business engagements. Therefore, the double-digit ISCS revenue growth is something that we would be returning to in FY26 and 27.
Okay. But Q4 also would be similar to Q3, or we can see some growth over the last year, given the last year there were around 14 billion.
Look, I think Q4, let's see how it progresses. I think I've given you a fair idea on where the margins will have come through. Normally, in some parts, like for example, India Q4 is normally a strong quarter. But we'll have to see how it evolves in the rest of the world.
And lastly, whatever projects have been delayed, so we expect them to start mainly pushing in Q1. So that's a fair assumption, right?
It's one project. I also want to kind of maybe place this in context. Look, this is a massive project for a very large company in the UK, and it's a significant transformation project. It's quite normal that projects of this size, which impact the entire value chain, supply chain of a large company, sometimes the customers and both us could be measured in terms of pushing them to go live, considering the impact on the supply chain. So a 3-4 month delay towards the right in a large engagement, normally we are on time. Because of the size of the engagement, we've had to call out the impact, is not unusual. It's just that 3 factors work together, which is again, how should I say, again unusual. That the project got delayed. December, it happened in the Q3 quarter where volumes were soft, and we had softer margins in GFS. All 3 coming together, which has impacted the P&L. Going forward, the project will, like we said, by Q1 FY26 would be on stream. We expect, in fact, as we see, we expect volumes in the other UK customers to get back to normal. And we also expect to take the actions. And the most important thing is, we listed 5 actions. We are working very hard and on a timely manner on those actions. We expect those actions to start showing benefits.
Okay. Thank you, sir. Those were my questions.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Payal Shah from Million Securities. Please go ahead.
Yeah, thank you so much for the opportunity. I have few questions. First, you mentioned in your opening remarks about the profitability in IFM business in the next quarter. So just wanted to understand what sort of margins and numbers should we look at? Does this business have a potential of the size and scale of our ISCS business?
So, while we always messaged that network segments we would like to hit 7% EBITDA. And today we are at about just under 4, right? The objective of the IFM turnaround is to push towards that 7%. Both the businesses in the network segment, GFS and IFM, as a first step should hit the 7%, right? The good news is that the trajectory we had mapped out, and we had clearly messaged that probably last year itself, that it's going to take till December of FY25, is on track. And from next quarter, we should see the journey towards the 7% mark. So that's the first step. Now, I think your broader question, given the scale, should we start moving towards the ISCS margins? Look, internally, that is something that we would always like to get there, because when we initially talked to the markets, we always said there's probably going to be 100 to 150 basis point difference between ISCS and network. What has really happened is ISCS has gone faster into the higher margin territory, to the 9.5 and 10.5, and network is now trying to catch up to its, the norm, which is about 7%. So I think right now we are focused first on getting to the 7. I think once we get there, we can have a good discussion in terms of where else it can go.
Oh, okay, that's quite helpful. My next question is on what would be the contribution of GFS and IFM of the overall NS segment, and what will be the margin for each business?
See, I think we have probably not disclosed the split between GFS. We do it on an annual basis, right? When we do the March quarter results, we typically give out the region-wise numbers. At the moment, the margins are kind of pretty similar right now. One is not holding back the other, or it's kind of both are contributing equally to the network segment.
Okay. I'll join back with you. Thank you so much.
Participants who wish to ask a question may press star and 1. The next question is from the line of Kunal Shah from Anova Capital. Please go ahead.
Yes, sir. So on ISCS front, I just wanted to know how is the North America geography performing? You have talked about India and UK. Can you throw some light on this region as well?
It's doing extremely well. In fact, in my opening remarks, as well as I talked about the margin, North America is doing very well on a margin front. It's doing well on a revenue front, and we also see a strong outlook for that as we go into FY26.
Yeah, I'd just like to add that North America, has one significantly large deals, which we I think announced early quarter, and from a pipeline perspective, it looks extremely robust. So North America is a significant engine of growth for us as we look forward to the future.
Okay, so thank you. Thanks.
Mr. Kunal, does that answer your question?
Yes, sir. Yes.
Thank you. Ladies and gentlemen, if you wish to ask a question to the management, you may press star and 1. The next question is a follow-up question. It's from the line of Disha from Ashika Institutional Equity. Please go ahead.
Hello.
Yeah, Disha, please go ahead.
Thank you for the follow-up opportunity. I just have one question. You mentioned that the contract in UK was a very strategic contract. That is the reason why there was a 3-4 month delay, and you had to call it out. Now, considering that we are expanding in the rest of the world market, and we are going to undertake any such strategic contracts, I believe we are undertaking one in North America as well. So, if in case any future delay such as like this happens, it impacts your profitability and your profitability margin. So, is there any particular step or any change in contract type that you will undertake to ensure that no such profitability margins are impacted?
Hey, Dishan, I just want to kind of place this contract in perspective.
Okay.
I think, and actually thank you for asking the question. Maybe I'll share a little more information. We've been working on this project for almost 18 months. The project itself was supposed to evolve in 3 stages. The first 2 stages went exactly as per plan, and we've actually recognized a revenue and margin from that. This third stage was a step up in terms of the revenue and the margin we want to get from this project, which is what got delayed. Now, the reason we are calling out this in this quarter is, to be very honest, if 3 or 4 factors had not come out together, we wouldn't have expected this kind of an impact on the quarter profitability. Normally what happens is most of the business performs to as expected. You would have 1 or 2 projects kind of getting impacted. That's part of normal business. And the company has adequate profit cover to kind of manage through their profitability. It's a very unusual quarter where you have, and that too in the most predictable part of our business. SCS UK is our most predictable business for the last 25-30 quarters. It's unusual to have a project delay, lower volume, all happening in the December quarter. And that's why we had to call it out. So the combination of factors that I talked about, look, it's very unlikely that everything will come together like this in a single quarter. That's one. So second thing I want to talk about is, as we see this, when we budget for contracts also, we are quite measured in terms of the way we budget, how contracts come in, how revenue is budgeted. So because, all these contracts would have some bit of uncertainty, we make sure that we build that in our own budgeting and messaging to the market, right? So we do that. And then we have robust project management systems to manage it. The last part I want to talk about is, as management, we don't want to stop by saying that, look, this has been an unusual quarter. The reason we are messaging 5 initiatives, and I'll go through them once again. I talked about strategic pricing in IFN. When I say strategic pricing, I'm talking about significant pricing, not the normal 2-3% that a market would expect. We are talking about infrastructure consolidation. We are talking about overhead reduction. We are talking about headcount rationalization, and we are talking about outsourcing, increasing outsourcing. Now, all these are stuff that you anyway do, but the reason we are calling that out is we want to be extra sure that we create space in the cost structure as we go forward, right? And that's the learning that management takes away from this quarter, right? So I hope that kind of gives you a little bit of, context in terms of the way we manage projects and how this quarter was and what management is doing.
Yes, thank you. That is it from my end.
Thank you. Participants who wish to ask a question may press star and 1. The next question is from the line of Vikram Vilas Suryavanshi from Phillip Capital. Please go ahead.
Yeah, good morning, sir. Just to take it forward on global freight forward business, in terms of network expansion, how much scope is there for, at least for, say, our direct services, or is it like a more done and probably, as you said, cost control would be the focus area?
Vikram, do you mind just repeating the question? Because was it network expansion or freight? Something that you're asking wasn't very clear.
Okay. So my question was regarding global. Am I audible?
Yeah, yes.
Question was regarding global freight forward business. How much scope is there to expand our service for direct routes? Or is it more like a captured most of the major market?
So let me answer that. Today we operate around 16 lanes, lane being target and destination. So we have no immediate plans to expand our network. We continue to focus on these 16 lanes, and these 16 lanes are predominantly based on the kind of shipping frequency velocity that we see from our key customers. So no immediate plans for any network expansion. So we'll continue to focus on bringing more efficiency and more throughput in the existing network. I hope I answered this question, Vikram.
Yes, sir. And also there was some volume pickup between China-US route prior to election. Apart from the Red Sea, we also had seen that impacting availability of containers. So how is that situation playing out going forward? Now we have seen US particularly playing with the tariff rates. So in this backdrop, what kind of growth or what are our strategies to grow volume?
From a container shortage perspective, I think that phase is over. That was more because I think it was a more a Q2 phenomena where there is massive shipments going from China to US. We are not active in the China-US lane, Vikram, so it's not an area of focus for us. But our focus is really China to Europe, so we'll watch that space because we need to see how these tariff wars pan out. So we keep a close look on it to see how it impacts our key lanes. So India-US is a strong lane for us. China to Europe is a strong lane, and China to Australia is a strong lane.
Okay.
So we keep watching these based on what's going to happen with the tariff wars that are out there. But right now, the China-US is not impacted. We are not impacted because we don't play on that lane.
Okay. But broadly, just to take it for this quarter only within network solution, was that integrated final mile margins were more impacted compared to GFS?
See, IFM margins were impacted last year, and probably as we got into the early part of the year in FY25, we have seen a good improvement in the margins in the last 3 quarters, and we expect them to get to run rate in the next couple of quarters.
Okay, got it. Thank you, sir.
Thank you. As there are no further questions from the participants, I now hand the conference over to the management for their closing comments.
Okay. Thank you for all your questions, and just want to say that we're very, very bullish about where we see ourselves in the medium term to long term. Our pipeline is extremely strong. We continue to have a very, very strong velocity of proposals going into Fortune 500 customers. We expect a higher rate of conversion. Like I said, we are pretty much on the verge of closing a very large deal within the Fortune 500 segment again. So our focus on large customers, our focus on global account management, these will continue to drive our business development effort. And a lot of the measures that Ravi Prakash spoke in terms of bringing in a significant amount of cost management will bolster our profitability as we go forward. And we continue to remain extremely confident as we get to this.
Of TVS Supply Chain Solutions Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.